But we have 7 o'clock this morning, delineating that here. This is kind of like what you should be doing, Caleb. And then we have the run here, creating the initial buy side liquidity, and the low, taking that out here. So we have a minor sell side liquidity pool resting right below here. And you can see how we're working the initial sell side liquidity, which is that low right there. Now, whenever I have a time where if I'm looking at a specific element of, for instance, like 7 o'clock, say it's your opening time for your trading, as we were talking about last week. If you're going to be looking at the charts and start watching prices early as 7 o'clock in the morning, you're going to be met with something like this, where you'll have a high right here to the left of your start time, and then actually right at 7 o'clock creates a high. Whenever it's like that, I'm going to wait for the initial run, because I know it's probably going to take this high out, and it's certainly probably going to, hear that? Certainly probably, I just coined something else, the short-term high is created right at the 7 o'clock candle. So that initial liquidity is an interest to me. So I want to watch and see, does it in fact trade above here? And if it does, I'll give it some allowance, okay, to trade there. I'm not trying to annotate that high. I want to see the short-term high here form and then start to trade lower. And if it takes out that low, then I'm highlighting that high and I'm highlighting that low. So now you can see we ran above this here. And if you scrub over here to the left a little bit more, Michael. So you have all these relative equal highs. The market did in fact make a run above that. So that disrupted all that price action over there, which leaves this low, which is a minor sell side liquidity. It's inside the range starting at 7 a.m., but it's also inside the range that was formed from the run from the London session, which is over here. Now, initially when I'm looking at this, my eye gravitates to this low, and it also gravitates to these lows here, which is why I have this low in mind, this low, and this low, which is why I have all this highlighted as a layered sell side liquidity pool. So there's a few of them in there that have my interest. This is relatively equal to that, and it's also slightly higher than that. And then we have this low here. Even though this one disrupted that, I have to at least consider that. Okay. The upside, where we had these relative equal highs, and we had this old high here, which is initial buy side, we've already ran that and started to sell off. So on the buy side of the market, it's been made jagged initially, but we have no news data ahead of CPI and PPI going into Tuesday and Wednesday's trading. So when we have that, it's kind of a little bit more uncertain, I guess the right words would be. So you have to pick your shots a little bit more carefully and kind of like analysis. I got peanut butter on the roof of my mouth too. I snuck a bite before I gave it to them. You have to do your analysis a little bit more critical than if you had a high impact or news driver that's medium impact during the morning session. And since we have nothing of that this morning, and we have some really big heavy hitters for Tuesday and Wednesday at 8:30, they're going to move around a lot. So a lot of interest is kind of deferred until after that report comes out on Tuesday and after the report comes out on Wednesday. And if you take a look at your economic calendar, you'll see what I'm talking about. It's the PPI and the CPI numbers. I don't ever care to know what those numbers are actually stating because, frankly, like I've mentioned many times before, it's of no interest to me. I'm not going to be astute enough to know what that data is going to tell me for a buy or sell. It's not giving me any kind of information that is actionable. So therefore, I never consider worrying about what the raw data is. I'm sure some of you in here listening that are very interested in the fundamental aspects of the market. And if that suits you, then, well done. I just don't have an interest in that. So therefore, I defer all of that to everyone that wants to consider it useful. I look at the time when the market is likely to give those types of runs. They go protracted, usually one directional. And then sometimes they'll change on an aggressive reversal and go the other direction. Most of the time, it's just a one-directional landslide, okay, or just blows up and goes straight up. And it's really, unless you're really positioned early on, something in London or whatever, which I don't try to do that. And to prove my very low interest in trying to be in a directional move for CPI or PPI, I have on Twitter Spaces in the past mentioned what I thought was going to potentially pan out and what direction it may aim for. And true to form, it's never accurate. So I shouldn't say never. I think I was right twice last year with the CPI and PPI, but otherwise, I'm usually wrong. So I don't need to do that for years and years and years, just to belabor the point and say, okay, well, this is not advantageous for me. So I sit on the sidelines and I wait for more information to come after that market is moving because of the intervention, because I don't know where they're going to put the market right as that report comes out, and no one really does, to be honest with you. No one knows that. And even if someone had an inkling, I'm confident that if a position was placed large enough ahead of it, they would run it the other way just for the sake of upsetting it. So that's the conspiratorial mindset of Michael, right? So I'm not interested in worrying about all those types of things. When we look at the market, it's probably better for you to trade when it's not having a day like this where there's no real data to concern ourselves with, and trade in the afternoon. But if there's things that are in the marketplace that are more conducive for taking trade setups, looking for price runs that move to a logical price level, where it's really telling, it gives you insight that I guess goes against the grain of retail stuff like supposed diagonal support and resistance or indicator crossovers or oversold, that type of thing. If I have those types of advantages in price action, and they're hinting to the likelihood of that arm wrestling match I talked about last week, where we have smart money concepts, time and price, and liquidity and inefficiencies. If that's arm wrestling, if it's arm wrestling the central tenets that go along with retail trading concepts and things that lead to, in my opinion, guessing, I guess it's more appropriate for me. I'm not saying it should be appropriate for you, but if you have an affinity for just trying to trade every morning session because that's your operating hours, if you have those types of things in play and you can identify them, you don't really need economic calendar to, I guess, push a narrative or push a sentiment. You can just trade the price action itself. You don't need a whole lot to go on. But it's in my interest as an educator to kind of like promote the idea that an economic calendar behind you, moving with the ideas that you're looking for technically, that in my opinion is better. So when you have a morning without economic data, it becomes a whole lot more problematic in terms of seeing sustained price runs. You have to know what you're looking for, where you're looking to take profits, partials, move quickly to protect your position, not try to look for home runs. Give yourself flexibility, knowing that you potentially may get it wrong because you have big news on the following day and day after. And that, in this case, we have that with PPI and CPI. So it's important to pay yourself if you get the opportunity to do so. Give yourself the opportunity to see if it can run, but don't punish yourself if it doesn't. Case in point right here. Partials always pay. You never have to worry about being right or wrong once you take your first partial. It completely removes all of that necessity about being right or wrong. So let me cancel this order because it should have given it to me. In my opinion, it should have went down there, but it didn't. So because it came back, I have to sit and relax and give some more time to the marketplace. We have the opening range still here. I think we'll still come down in here, even though it took me out before it actually did it. But this would have been a transaction that would not take away from the equity. It added to. When we have opportunities to see the price action move in our favor, and we don't take partials, if we do not take a piece of the pie, if you will, or a bite or a pound of flesh before it gets to our major objective or our terminus, our main target. If that's not the case for your trading right now, you need to start adopting that, because especially with the volatility that's in the markets today, I'm not saying specifically today, but in recent months and years, that volatility is going to give you a whole lot more adversity. The markets could come back multiple times into the general vicinity where you entered the trade at. And when you have the potential for the market to pull that deeply back into your trade, if you don't know what you're looking for, if you're afraid to get back in, or you just lose the plot, you have no idea what it's doing, it's better just to take that victory, whatever that was. In this case, you see a limit order was filled. You see that a stop loss was brought down to protect the underlying position, and it came back just to take it. And now we're back inside the range created from that run here to that short-term high, and we have yet still to take out. Let me take these little identifiers off for a second so you can see. Just fell short of running into that. Okay. Now, these are the little gremlins. Okay, the little gremlins that creep in to your trading, and you can get emotional about it. You can get mad about it. You can punch the air and say it's so-and-so's fault. It's somebody else's fault. Or you can say, you know what? I was part of a move. I looked for certain signatures to pan out. It gave me the opportunity and displacement, and it ran to obvious levels of liquidity. It took out this short-term low. I wasn't interested in having any limit orders below that. This one here, I like that. And I have this one shaded orange here. Okay, and what that means is I want to see it get below it. Each one of these candles hasn't really given me a kind of like a trade below it, spend some time below it, and then come back up and tap into it as a potential inversion fair value gap. If you're ever looking at my charts, if I'm sharing shaded areas on price, if it's shaded orange like this, to me, okay, my interest is some facet of seeing price go below it and come back up, and then treat it as a means of barrier that it doesn't want to get back above it. If I start watching candlesticks promote that idea, and then I see a displacement, I might invite the opportunity for them to put me into a short with a fair value gap, a institutional order flow entry drill, I don't know, maybe a bearish order block, something to that effect. But it hasn't given me enough information here to justify that yet. So I'm watching to see if they just take out this short-term high, and then what they do after that. If it was to take like this high out, or maybe come back up and even touch in this again. If it can get back below this one here, then I may entertain the idea of maybe trading that down below here. I do really like the idea that they've kept this low and this low in the kind of like in the rule book, if you will, that now we have relative equal lows there. And this one here has a lot of liquidity in it because we have, it's 5 a.m. It's during the close of the London session. So we see the market wanting to reach down into that, but then stop short of it. Okay. And I'm quite certain that Phil, P-H-I-L, yeah, said no, not today, because ICT's got a limit order down there, and then came back for the stop. But who's Phil? So I'm interested in seeing, does it now want to go down below this area here, come back up, and then does it displace? It could do it, and it could do it so quickly and violently that it doesn't really give me a chance to get in it. But I want to talk about the importance of knowing when these high impact news drivers on the economic calendar, like we have a Monday. Okay, generally, I'm not a real big fan of Mondays. I like to see other traders go out there, put their neck on the block, and then see what the general consensus and sentiment is on a given week where we don't have non-farm payroll. Okay, so if we have non-farm payroll, I'm interested in trading on Mondays. Every single Monday that has non-farm payroll Friday, I'm trading and engaging on Mondays trading. I'm absolutely looking for moves to do, something that gets me into a trade. Generally, I'm not interested in Mondays otherwise. And because of that, I'm trying to counsel my son and his brothers, if they watch these videos too. I'm hoping it will inspire them to do it as well. But they shouldn't be trying to trade on a Monday in the morning session ahead of PPI and CPI numbers like we have here. So if there's ever a real big, huge neon sign that says, don't really try to trade on this, because I know a lot of my students will say, and a lot of people that don't like me, or they try to troll me for clicks and views and ad revenue or attention, they'll say ICT never trades, or he says never trade on Monday, and then they'll show their after the fact trade, and they'll say this is what I did, and that's great, well, kudos, but there's a lot of things I don't personally want to do as a trader, and other people do, and they make money. I'm not arguing that, but what I'm saying is because you're here watching my content, the interest is you're wanting to know my opinion or what I'm thinking or what makes me tick about an idea about a market going higher or lower. And what do I look for in terms of a trade idea? What do I look for a setup? Okay. Or when do I try to avoid taking those trades? It's important for my son to know that it's problematic on days like this because, number one, it's the morning session. Everybody's chomping at the bit to do something. And large pools of liquidity, big players in the marketplace are not going to position this morning because they know what's waiting on Tuesday and Wednesday. So because of that, just know that you're going to see a lot of this type of action where it's up, down. It's real skittish, meaning that it goes up, it goes back down, it goes back up, it goes back down, and it becomes very, very sloppy real quick, and it becomes almost seek and destroy like. Now, what is seek and destroy? Seek and destroy is where the market will go just above a short-term high, just to go back lower to take out a old short-term low, and then come back up, take out that short-term high that was just formed, and then vice versa. It'll go back and forth, and it kind of runs you over, even if you're in a position, as you saw here at the opening of the stream. Even though I can be right in the direction, and I can see where it wants to potentially go, here we are, it can still come back and take me out. Now, if it wasn't a Monday with the PPI and CPI numbers coming out on Tuesday and Wednesday, I would go back in and short up here. But because it's not conducive for that, because we have huge news coming out Tuesday and Wednesday, I know that the probabilities are likely. Didn't think I saw that coming, did you, Phil? The high being bumped there and then trading lower. Here is the new week opening gap high. So the bias, as I was teaching last week, here's your new week opening gap for this week. We had price above it. It rallied up. It took liquidity. And where's the draw going to be? Where's that like black hole of just constant tension and pressure to pull price? Caleb, it's the new week opening gaps. Okay. So if we have that, and we have an old new day opening gap here, we'll have a new one tonight when 5 p.m. comes, and then we have the opening at 6 p.m. We'll create another new day opening gap. But right now, we have to work with new week opening gap and old. Remember I told you last week that the new day opening gaps have a shelf life or life cycle. Not that it's limited to 5 days, but if you work with them in that perspective, you'll see how the market uses this idea where it gravitates back and forth towards these levels. They're inefficiencies that will be used again, like a magnet will draw price to it. So when we're looking at bias, these are going to be your first central tenets to trying to derive what that bias is. So if we know that the new week opening gap is here for this past Sunday or yesterday evening, 6 p.m. in relationship to, I guess if I scrub over here, you'll see. Well, we'll come back to it in a second. It's less than 20 handles. So therefore, I'm not really interested in annotating the quadrants inside of it. You can eyeball it. It's about halfway here, and the upper quadrants here, and lower quadrants there. And if it can trade through that, and then we go back into new day opening gap of the 9th. Okay, so that's Friday's new day opening gap. That would have been formed and calibrated from Thursday evening, New York local time. It's Thursday's 5 p.m. closing price and settlement, and then 6 p.m. 1 hour later, new session opening. So between those two price points, you get it here. And again, it's not annotating the quadrants or the midpoint because it's less than 20 handles. Okay, so if we have a previous new day opening gap below price, and we have new week opening gap here, and the market was made jagged here, and we have inefficiencies that we're respecting it, the market's going to do what at the opening bell? It's going to gravitate in the direction of these old inefficiencies because the market is algorithmic. So it has to refer back to those same things I was teaching last week. So that way we're not sitting here staring at book map charts, okay, or things like that, and talking about nonsense. And the whole time the market's moving and not having had a trade or even knowing the bias. And there you go. So you want to screenshot that. Okay, you want to screenshot it again and put it on your calendar. The ICT was talking about this stuff last week and talked about it live, coming back up and just bumping this high here and then ripping it down. Here's your open, trades back up, touches the bottom of the inversion fair value gap. That's a trade, not on a day that's ahead of PPI and CPI. And the market rips lower, eats right on through all of the layered liquidity here, upper quadrant level. Trades lower, and look at the bodies, how the bodies are stopping right new week opening gap. See that? Isn't that beautiful? So it's probably random. All this stuff probably is working off of, some classic Steve Nielsen chart pattern. Oh man, I can't help it. I have to do it. I have to do it. It's my burden. I have to carry it. So the idea of looking at bias, I gave you those elements last week, okay? And using them, fortifying that as part of your repertoire and your regimen, your guidance that I gave you last week. As you can see, all those rules are still here. They're still here, and we're trading down into the previous Friday or week of new day opening gap. Okay, so I know some of you may look at these ideas and think, well, this is pretty complicated. It's very hard for me to get a feel for what he's doing, and that's normal because you're getting exposed to it for the first time, and because you have TikTok mentality, you think it should be understood in 30 seconds, and it's not going to be like that. First of all, you have your brain clogged up with nonsense and things that other people sold you in books and courses and lied to you and said this is what the market does and this is how it works, and smart money concepts are nonsense and there's no algorithm. But here you again, I told you last week, we're going to sit here and you're going to see this stuff working again. Here it is. Okay. But trading to the midpoint, okay, or consequent encroachment, that ends my interest in the morning session. It could come back up into this and then rotate one more time just to take that low out and trade the consequent encroachment. And that would complete my day or my morning session or the interest thereof. I would not be interested in trying to buy it. I would not be trying to go long. I would not be trying to go into a short that hopefully moves 200 handles or plus. That would completely be against my expectations. And why would I have that opinion about not doing much more or having an interest greater than what I've outlined here, which would be consequent encroachment? Number one, it's already moved one-sided. It's had a really nice displacement lower. It just tore off, went a lot lower than most of you probably were expecting. But it went right to the levels I was showing you here in the live stream. It was going to draw to these levels because we've made a run higher during London. We rallied up, bumped a previous high, and then we had the market create jaggedness, as I was talking about. Okay, so there you go. It completely went down to the low. So I'm done. I would move to the sidelines, and everybody that's been following along and went short, take your profits and be content. Okay. I don't care if it goes lower, just take your profits and move to the side. I know you guys are following this and you're thinking he's got these levels on there and I know it's going to fill. So I'm going to use my own methodology and I'm going to trade to his levels. I don't want to hear about it. I don't want to hear about it. Please don't give me high fives in the comment section. Even though I'm the only one that can see that, don't do that. Because every single time I see a wave of people doing that and they're like, thank you so much. I took a trade on this and I used your level. Don't do that, because that means I'm going to be worrying about you. And I don't want to worry about none of you. Okay. But let's take a quick look real quick and recap what was going on. We have an old clean level over here, which very well could go up there and bump that. But we have to use the rules as I outlined last week, where you start looking at 7 o'clock and you're going to wait for relative equal highs. Okay. Relative equal highs. Boom. Boom. What's this high in relationship to that one? Is it higher to the high to the left of it or lower? It's lower. So doesn't that mean that meets the criteria, doesn't it? Yes. So when you have this or the candle at 7 o'clock, it just starts to drop down from there. I'm not interested in ever classifying that as the initial point of buy side liquidity. I'm not interested in that. I'll wait and defer my actions on annotating and labeling because I know just to the left of that, it's here too. So I want to see it form literal relative equal highs. So in case you missed it or I didn't give you a good enough explanation of what I meant earlier when we first started talking, it's in the rules I told you last week. So it's not like I'm ad-libbing here. It's what I said last week in the lectures. So you're going to wait. So if your starting point is not 7 o'clock, okay, say it's not 7 o'clock and you start at 8 o'clock, right there, okay, the same thing. You're going to refer to any relative equal highs that have not been pierced or breached that formed after 7 o'clock, but sometimes they will already have taken them out. And then you'll have to sit and wait for your own relative equal highs or relative equal lows to form post 8 o'clock. If you're going to use the 9 o'clock hour, you have several other factors that you can use. Okay. The opening range, as I was showing Caleb last Friday. You all as students are familiar with this because I've shown this before using the regular trading hours. So if we were looking at it this way, are you mad, ICT, that they stopped you out before it dropped? No, because I know this is going to work again. It doesn't just work on one day. Okay, it works every day and every week, and it won't stop. So if we have, what's nice is I'll explain to you that they would probably run it to this fair value gap, maybe bump and clear the highs, and then drop it lower. So I can anticipate, and this is with experience, and this is also a little bit understanding the source code, what they'll do. If I'm going to be wrong, how will I be wrong? Now, for someone that may hear that and think, wait a minute, if you know you're going to be wrong or you're potentially going to be wrong, like, that's not bragging rights. If you know you're going to be wrong, why'd you take the trade? Well, there's going to be times where you get into a trade, and when you take that trade, it seems appropriate. And then the things that you were looking for start fizzling out, and they are no longer supporting your trade. So it becomes a much more likelihood that you're not going to get the objective you're seeking. And if it's something that you anticipate potentially closing the trade on you prematurely, wouldn't you want to move your stop loss in an advantageous location? So that way, if it was the reverse on you, you still go home with something, not a loss. That's the parts that comes from learning from me talking. When I'm talking about specific things, if you don't have a frame of reference to refer to the logic as to why is the trade still viable, why should I hold the trade, what prevents me from getting back into the trade if I get stopped out, there has to be rules for that. I knew there was a strong likelihood that these relative equal highs could be retraded to, because that the CPI and PPI numbers are coming out Tuesday and Wednesday. And the characteristic of this morning session ahead of those days tends to be a lot more of this type of stuff. Back and forth, back and forth, back and forth. And then bump, stop me. And I said, and then once it does that, good old Phil will take the price back down to where I said where it was going to go. And it did. So I can get mad like I did when I was 20 and say, oh, you so-and-sos, you did it to me again. Or I can say, you didn't beat me today. Even though you took away the majority of what I was trying to do, you didn't take everything from me. And that's the benefit of knowing where to take partials, because as soon as you take partials and you run your stop to a position of covering any costs, you are in the closest thing to nirvana as a trader, because now the outcome of the trade is no longer all that critical, is it? No, because you've taken something out of the trade. You've locked in a position where even if it were to come back on you, you can't lose. You can't lose, barring some crazy gap, that's always there. But you technically, barring some crazy volatility gap that would be unrealistic to expect. I guess it could happen now with all the stuff that's going on over in Europe and the Middle East. To the Brits last year, when I was talking about watch Britain, watch the UK, you're gonna have some crazy stuff happen. Are you paying attention? It's almost like reading price action, isn't it? So just be careful over there. And it's going to be coming here, and it's going to come to Canada, and we're all going to feel it. But the point is, you can react to those types of stimuli where you get stopped out prematurely and go back in and hunt, try to do something extra because you didn't get your full run. If I pull this back up, this old high, those are the relative equal highs that the market was reaching for. But this is the level of least importance to me. What I want to see it do is trade above these highs here. Why? Because starting at time, 7 a.m., my interest is there. So we go up, we go down, we rally back above. So the buy side is taken, and just for good measure, it takes out the highs from the previous session. And then we break lower, and we have a fair value gap. Okay, and the market trades up into the fair value gap right there. And I'm looking at how the market wants to use old inefficiencies, because I'm thinking it's going to stay heavy and really work towards this low a lot faster, because it wants to do the moves generally a little earlier when we have big news on a Tuesday and Wednesday like we have in our academic calendar. When do you trade these early sessions, ICT? Why are you sometimes taking trades before 9:30 opening bell or before 10 o'clock's silver bullet? I've said this before, but this is the part where you write it down, okay? If I have an economic calendar that has like these big impactful events on the following trading day, then I'm going to try to take the trades early, because everybody's going to be in here trying to do something at the opening bell. And it's also a Monday. So because nobody blew up anything and we didn't go thermonuclear over in the Middle East, everybody wants to go in and take a lot of trades. So there's going to be a lot of volatility. There's going to be a lot of interest in trades right away. And I want to be in when the market's the cleanest. And how is that going to be determined? Well, what I taught you last week at 7 o'clock to 8 o'clock. I'm going to use that first 30 minutes post 7 a.m. and that's here. Okay, so here's 7 o'clock to 7:30 right there. Okay, so what did we form? That high, that low. That's why I'm delineating those levels. Okay, in case you have forgot last week's rules. So we traded down below it. Okay, so now we're going to wait and see. Does it want to come back up and upset these here? Knowing full well that the new week opening gap is down here for this week. August 11th, that's Sunday opening from Friday's closing settlement price. That's what the new week opening gap is. So since it's below it, and then the next new day opening gap is last Friday, the 9th, where is that? Down here. So all we're going to do for guidance, All we're going to do is follow the rules I gave you last week. We're going to wait for the market to be made jagged on the opposing side of where these inefficiencies are. Isn't that easy? All you're doing is waiting for them to run up, take out the smooth areas right here, and they ran through the previous highs, and then did what? We break lower, and then we have displacement in here. So if we go back through all this price action here, we can then start looking for, hang on one second, I thought I had my laptop plugged in. In case the acoustics are acting a little weird in the audio, it's because I'm inside the great room of my first floor of the house, so I have really, really high ceilings, and I can hear it as I'm talking. Sometimes it's like echoey. I'm in a big room here, so hang on one second. Let me plug this in before I lose the power. Speaking of power, last week we had the remnants of Hurricane Debbie come through, and the wind was kind of whipping up, so we lost power for a moment until I had all my generators turned back on. Since I wanted to leave the session last Friday at 10 o'clock, I had no interest in trying to log back in, and I had to take care of what I had to take care of, so I wasn't going on the site or the community post to try to tell you what was going on because I had things to take care of. But anyway, we had this inefficiency here, and going back over through all of this. See all this right here? All this inefficiency, even though we went back and forth through it here, I'm aiming for all that in there. And then we have this inefficiency. I traded into it there, right at the bottom, right there. You see that? I want to get in the trade. Some of you may see what I'm teaching and say, okay, I can see the fair value gaps. I can see the inversion fair value gaps he's talking about. I can see the order blocks. Okay, I can see it. But where do I get in it? Well, if I'm trying to trade and get short, I'm going to use the lowest probable resistance in terms of getting in the trade. In other words, I'm going to use the lowest threshold level on a fair value gap that I think is going to hold price down, because I have tried many times to be very, very, very precise with the stuff I understand and know what the market's likely to do, more times than it's not. And I've watched my limit orders. It prints the price that should have given me a fill, but it doesn't do it, and it runs the other direction. And to me, as a 20-year-old, that used to really make me angry, because it made me like, come on. This is like, I took it personal. I literally took it personal. And I'm assuming, like in this live stream, you have to assume that they're just simply not going to let you have it, especially if you're right a lot. If you're right a lot, you're standing out. There's going to be a lot of other people that's doing well, but they have an issue with just you. And I'm not saying you, I'm talking about me specifically. They can't stop all of you, but if they stop me, that discourages anybody from trying to follow me or the logic that I teach. See the difference? So take out the king. I'm not saying I'm the king, but take out the king and the pawns will fall. So if I share my stop loss orders, if I share my ideas of where I'm actually going to try to get into a trade, I'm actually creating liquidity and even a larger bullseye. So I try to do things in a manner where I don't want to draw too much attention to it, but you can see all of the logic is still here. But entering in the inefficiency over here, extending it through, what is it? What is this right here? What is that right there? This inefficiency, what is it? What kind of classification is that? Well, for folks that think they understand fair value gaps and whatnot, they think when it trades up there, it's going to sell off. Not if you don't have the information I'm teaching you, because what are we expecting? We're expecting these relative equal highs to be taken in as much as these levels up here traded to. Go back and listen to the lectures last week. If you're watching this one and didn't watch the last week's lecture, or skipped or didn't really listen to any of the things I said, and you just watched and maybe were bored to death and turned off the thing because you think it's not of any interest, go back and really go through it and listen to it and take notes. Scout's over there snoring. You'll probably hear it. It is a reclaimed fair value gap. Meaning that, see, when the narrative and the time are not in an agreement, even though it trades back up to these inefficiencies, you're thinking just like everybody thought a down close candle. Every single time a down close candle's touched, the market's going to go up. That's what everybody over on Baby Pips thought when I was first teaching about the idea of my order block. And because they tried to do those types of things and assume that, okay, it's going to go up, it's going to go down based on these candlesticks that ICT was talking about. And when they failed in their own hands, because they didn't understand the narrative, they didn't understand the logic and how to actually use them, they run away and say, well, it doesn't work. And then you have a lot of people that are doing that. And you have new people coming in and they have an interest and say, well, I hear a lot about this guy named ICT and these smart money concepts. And they start seeing other people's opinions. And because they're lazy, they'll take those opinions and say, well, they're saying they lost money. It doesn't work. So therefore, I'm going to avoid that because I don't want to be prudent and actually do the investigation myself and try to use it in my own hands and see if there's any valid use to this information. Nothing's really changing. It's just you're applying the same concepts of measuring time, determining where the liquidity is, and then waiting for this disruption. And the waters are made jagged or rough. Wherever it's smooth, okay, you're waiting for that jaggedness to come in. And if you look at what has been shown here, what I traded off of is these relative equal highs, this up close candle. I'm anticipating that as a bearish order block. Why? Because it's going above the relative equal highs. We had the market trade lower. It went beyond the opening price. Listen, folks, this is for order block fans, okay? My order block does not require to trade below the wick. If I understand the narrative, and let's talk a little bit about narrative. This morning, my interest was being short. I wanted to be short because we had a nice run all last week, and we really didn't see TGIF on Friday. I talked about it with Caleb. I said, I believe it could do it. It could potentially have a retracement as much as 20 to 30% of the weekly range. It didn't do that. They kept pressing it into Friday's close. Okay, wonderful. So how do I trade with that information knowing that TGIF did not form on a Friday? If the market didn't retrace 20 to 30% of previous week's range, and if it's an up close week, if I see that that's likely to happen, but it doesn't deliver, let's say I took a trade on Friday and I was trying to get short and it just didn't it didn't pan out and it petered out and maybe it caused a losing trade, or maybe it didn't give me a fill or it just didn't give me what I thought was going to happen. The end result is what was lacking. TGIF did not materialize and manifest itself on a Friday. Wonderful. So fast forward to Monday. If you're going to trade on Monday, and this is true even if there is CPI and PPI on Tuesday and Wednesday or later in the week, you can use this information. Anticipate the likelihood of 20 to 30% of the previous week's range occurring on Monday's trading. So it's TGIF, but the actual retracement of it is deferred to the following week. In this case, it's Monday. Do you need 20% of the previous week's range to be profitable? No. But it's one more little box to check that probabilities are better in the short than going long. So then when you start mapping out your day, 7 o'clock in the morning, as I outlined last week, determine what your initial high for buy side is and what your initial low is for your sell side. Wait for them to be taken. And if you have the weekly gap, the new week opening gap and the new day opening gaps are below price, and you have that function of determining, okay, well, it could retrace into some of previous week's range. You have a lot of things going in your favor that point to what? The initial run will offer you a range. So that way you can determine some kind of directional bias. That bias doesn't have to be the daily range bias where you're predicting the close is above or below the opening price. Remember, it's session bias too. And you need to be able to determine that first, Caleb. You need to be focusing on, in the morning session, I want to know where a run could form that is measurable. It's something that I'm able to participate in, and it's one-sided. Okay, wonderful. If you can see that we're above the new week opening gap and we have new day opening gaps below the market at 7 o'clock or 8 o'clock or 9 o'clock at the opening bell, then you know the weight of the market is going to be pressed to the downside. So the market's going to discover, probe into, discount a raise. That's something that's below the market price, and or seek inefficiencies that are deep retracements into previous week's range, or just taking out short-term lows that can be determined from a 15-minute time frame. Okay, so as the market was trading on this candlestick right here, we opened down here after a down close candle that closed below the opening price of that up close candle. Let me zoom in. Make sure you can see. So this opening price, all I need to do is see price trade below that. And on the time frame, I'm seeing this candlestick, which is the 1 minute chart. That closing price right there validates this as a bearish order block. All I need to do is trade on an uptick. Well, the next candle we open below that open price. So I already have that filter because it could have opened down here, or it could have opened above it. I want to see it open below this and then trade up. Where's my fill? See it at the opening price? Here's the opening. And there's where it's opening on this candle and trades up. I'm selling short when the market's going up. Okay. Stop loss goes to rejection block, which is the close on the order block. So we have a little bit of heat here, not much. What's it trading to? The initial buy side liquidity. That's these relative equal highs. Goes there too. So I know I can absorb a little bit of heat. It's going to come back and use this information back there because there is an algorithm. I know you don't like to hear it, but I'm going to prove it to you every day. And the market trades again lower. And then we have a gap in here. So again, as I teach, you're not using the wick of that candlestick right there. You're using the body's close. Why? Because it's different and there's a separation between the next candle's opening. So there's a volume imbalance there. So you have to incorporate that with your measurement of your gap. And then by doing that, you'll get a true consequent encroachment level, which is what you see all these candlesticks touching here. Right in here. Now, truth be told, this is the part where you're going to, if you don't like me, or if you're looking for something to do the gotcha stuff, or, oh, he's lying here. I had Piper sitting to the left of me in my morning room, and I had my laptop on me. And I was trying to draw all this stuff on here. And then I had my cursor sitting right over here, just like that. And I was moving her. And her claws, which I have to trim them back on her front paws. I didn't get a chance to finish her last week when we were doing her paws. So we got her back done, but she doesn't like to have it done. So I had to wait. Well, they were stabbing into me as she was pouncing on it because she don't want the other puppies to get near me. And I know this is probably boring you, but long story short, because I was pushing her away, I use a mouse pad, my laptop. Like I don't have an external mouse. It's like a touchpad. I prefer them. I like them. I don't like external mouse. I don't like it. It's just the way it is. I have to use it obviously when I'm using my screens upstairs. But if I'm talking to you, if I'm executing or managing something on the laptop, I prefer it. I don't have a little mouse that's external. When I pushed her away, I ended up touching the pad and put me in there. And I had to deal with it. I had to accept it. And there's no logic in here that justifies that fill, except for I pushed the pad without wanting to do so. But the trade is still viable. I know that it's giving me the information I want to see, because look at the wicks here. It only goes above it by one tick. It only goes above it by one tick. Okay, wonderful. The bodies are proving to me that we're only really respecting the lower half of this gap. See that? Let me take the thing. I'll put it right back on in a second. Give me a moment. You see how the bodies are showing how it's just respecting the lower half. You want to see my PD arrays and my inefficiencies and fair value gaps, whether it be sell side imbalance, buy side inefficiency, or buy side imbalance, sell side inefficiency. You want to see half of them not respected, because that in itself is insight. That's how you know the algorithm is doing exactly what you want it to do. See, when I talk about signatures and price and what the algorithm is doing, what the algorithm is doing this and when the algorithm is doing that, it sounds like bullshit if you don't want to believe there's an algorithm. But then when you start seeing me execute and it's the same logic repeating over and over again, or I'm calling individual candlesticks, then suddenly you're met with an argument that you have to contend with. I don't give two shits if you believe there's an algorithm. I'm enjoying the fact that I'm rubbing your nose in it. But there are times where these inefficiencies will come back entirely close in and still go lower. I do not like that. I don't like to see that in my trades. I don't like to see that in a trade that I'm waiting to see form. And for instance, say I'm trying to anticipate this as a return back up into it to go short, which is what I was wanting to do. I really wanted to execute as it hit this. That's what I wanted. I wanted consequent encouragement. I really wanted that fill. But because I'm allowing the dog, and I talked about this last week, when I don't let him up in my trading office, but I'm down here being with them. Otherwise, if she's not in the house, my wife, and we only have my youngest living with me and my nieces. So if they're not here with her, they're going to howl and cry, trying to get my attention. And that's going to be distracting. You'll hear them in the background. I won't be able to mute them because they're going to be howling because they want to be with me. Piper's the one that loves me the most, and she's trying to get on my lap. And I pushed the laptop and her away, and I did, and executed on it. I was like, oh, crap. So that's what that fill was in here. It was not me trying to get into a trade based on any kind of logic. It was just one of those things that happen in real life. Okay, it's going to happen to you, but when it does, what do? In the beginning, if you don't know these things, if you don't know how to trade and hold on to a trade or trust the logic, as soon as you realize you did something that you shouldn't have done, your best learning curve to experience is to close that trade and then see, all right, this is how I would still manage it. And what has it done? It completely disarms you. You don't have the weight of it has to be right. It has to pan out in your favor because now you're stressing about, oh, I got into a trade or I partially pyramided another position size in this trade idea. And now I'm worried about this was a mistake versus watching what is price doing. Okay. So the signature is you want to see the upper half when you're looking at a SIBI or a inversion fair value gap that should act as resistance, or if you are using a reclaimed fair value gap, that's a premium array. A premium array, you want to see the upper half of the inefficiencies or gaps. You want to see them leave that open. That's how you know the algorithm is respecting, number one, the PD array. And it's also telling you that you're going to see a measurable displacement in your favor. Now, right away, you should be getting this warm and fuzzy moment going over you right now, because that's the stuff that I never wanted to teach. That's the stuff that is not printing in price. So it's not in your candlestick. You want to see the things that are not in the candlesticks materialize. That means where there's an inefficiency, okay? How do I know when certain gaps are not going to fill? Oh, I go into every one that I'm referring to with a hope that they're not going to fill, because that's the algorithmic signature that I want to see in that. Now, if it goes up and trades to the top of it, then I need to see an immediate response and rejection there. And then it has to displace, and I won't touch it until it gives us another fair value gap on that time frame, or in this case, it's a 1 minute chart. It has to be 15 seconds, 30 seconds, something to that effect. And then I'll use a fair value gap on that time frame, because I've already missed the rejection, but I waited and looked for it at the top of the fair value gap. And once it starts to displace lower, then I'll just get into a lower time frame and get in sync with it, and it's fine. I ain't worried about it. That's the price delivery continuum theory that I was introducing last week. I don't need to be in the entries based on the time frames I'm studying. If I miss it, because sometimes I'm just being a little stubborn, and I'm trying to be very finessing about where I'm trying to get in at. I'm trying to impress either my son or some of you. Sometimes I won't get my fill, and then I have to go and use a lower time frame to get in sync with it. That's fine. It's very forgiving when you know what you're looking for. But that was what that was. Okay, and then I have this inefficiency here, which also has this. What's this candlestick? What's this green candlestick right here? it is a bearish order block, just like that one. So this opening price, did this candle close below it once it passed through? Yep. So that validates that as a bearish order block. So if I can see price create these areas where there's an inefficiency, and then I can label the very specific change in the state of delivery, which is what the opening price is on every order block, then what I'll do is I'm watching. I'm not doing this physically. You should do it when you start studying price with these things in mind. When price starts to trade back up into it, as it's trading into it, okay, I'm going to hammer that as a short. I'm not going to worry about if it fills me with slippage at the low of the gap. I'm trying to get inside of this order block between its opening price and its low. But I have to trade it as soon as it gets there the first time. I don't care how much heat and time I have once I get in it, because I know I have the framework of this right here, this gap, and the midpoint of this candlestick, which is what? Mean threshold. Some of you said consequent encroachment. Consequent encroachment is a gap. Okay, anytime there's a gap or inefficiency, the midpoint is consequent encroachment. If there's a specific range that's formed by the order block, singular candle, it's mean threshold. Okay, so the midpoint of that, essentially it's around here. Okay, so what is it doing? It goes right there. So it goes just outside of the fair value gap, but I'm referring to the midpoint of that gap. How do you know how to place your stop losses where they're at, ICT? When you put those stop losses in and you're putting it, and it looks like it's going to get real close to it, but it never goes there. It's this type of stuff behind me. I'm measuring all of the potential for the market to respect certain levels with this logic. And if it trades just to the top of the fair value gap, okay, what is it really reaching for? It's not that it has to go back to this. It's trading back to the order block, because that's what starts this run lower. Notice that? So that takes us to the minor sell side liquidity here. Why is it a minor sell side? Because it's a low inside of this low to that high when I think it's going to go down here. And I'm aiming down here in this layered sell side liquidity. And if it's going to go there, how far could it go? It can go down to the new week opening gap. And if it expands through that, what's the next new day opening gap? It's August 9th. Down here. And as I told you, my interest in this is in the mid part of that. Would I have, if I was still in the trade, would I have captured this low? No. And then trading down to this low, would I have held on further? No, I'm not interested. Because I understand what's forming. It's making the market jagged down here. It's enticing people. Keep selling short. It's going to keep dropping. No, it's not. It's done its work. And then it trades down to last Friday's new day opening gap, and then shows a willingness to want to go higher, and then trades right back over top of all this, and here's where we're at. Notice I'm no longer interested if it trades at that level here. Why? Because I have rules, I have protocols, I have understanding, and I know when to stop. When I get stopped out, and you watch me get stopped out in profit, there was not a loss. It's just I wasn't able to stay on the trade the entire run. Do I go back in and rush and get mad, try to get back? No. I don't need to save face. I don't need to fix a problem. There's no problem. I understand that the mechanics on a day like today, ahead of CPI and PPI numbers, back to back Tuesday and Wednesday, it's a Monday. I didn't have TGIF deliver on Friday. Okay, then it's going to be deferred. It's going to retrace back into the range during Monday's trading, especially if we open up at 7 o'clock in the morning here and we punch above the marketplace to upset what? Relative equal highs here. Where was that formed? In London. So I know that it's probable that it's going to go up there. It doesn't need to. All it needed to do was trade above these relative equal highs, because that's what formed after 7 o'clock in the morning. Just like I taught last week. The rules are not morphing. I'm not changing. I'm not cherry picking anything. Everything is the same thing every single day. And that's exactly what your trading has to be. If you're trying to change settings and you're optimizing bullshit because you're trying to look good in front of other people, if you're constantly optimizing, you have substandard bullshit. It's 7 o'clock, folks. 7 o'clock isn't changing when it's 7 o'clock. It does when you go to different time frames or time zones in the world. But I've already told everybody, calibrate everybody's calendar, everyone's clock, everyone's charts have to be ICT time. It's the same ICT time. It's the same ICT fucking channel. Everything's going to be the same thing every single day. You're not trying to reinvent the wheel. You're not trying to make it better. You're not trying to optimize. You're not trying to change settings. There's no fucking settings. Do you understand the value in that? At 7 o'clock, you're going to delineate that as a marking point. And then you're going to wait for relative equal highs and relative equal lows. Isn't that fucking delicious? Isn't that delicious? That it's not going to hide from you. They cannot hide it from you. How are they going to keep 7 o'clock from hiding? They're somehow going to hide 7 o'clock? Like, you can't look at the fucking time on your watch that's set to New York local time. Like, you're somehow going to just forget that 7 o'clock is on the front of the face of the clock. They can't hide that. Then what are you waiting for? You're waiting for relative equal highs and lows to form. And you're waiting for them to be breached. And here's the thing. If they have the market in a premium. Oh. You were talking about that in those mentorship videos, Michael. Could you peel back that onion a little bit more? Sure. Sure I can. Last week I told you, if we're in the time of day, 7 o'clock, 8 o'clock, and 9. In there, you're looking for relative equal highs to form. If we're above new week opening gap and clustering of new day opening gaps. All of last week's new day opening gaps, where are they in proximity to where we are here? Where are they? Where's price in relationship to this week's new week opening gap? At 7 o'clock. We're above it. The previous new week's opening gap, we're above it. So the algorithm is going to do what? It's going to seek fair value in a discount. So how can it mathematically and use time go back to a random fucking point unless it has a very specific reach to time, date, day of week, week of month, month of year, and where are these inefficiencies? When time of trading begins and ends. Oh my. Oh my, that's delicious, isn't it? My dogs like it. Hang on, I think it's probably Amazon. Give me 1 second here. I gotta tell you, I'll be honest with you, really. I enjoy these live streams because I don't have to go back and edit anything, and I'm really loving this new ICT where I'm not worried about, all the little quirky things that used to bother me. So anyway, when we have these signatures I outlined last week, and we start at predetermined times times of the day, which are what I gave you last week. We're measuring, we're waiting. What are you waiting for, ICT, at 7 o'clock? What are we looking for? Well, you're looking for a directional run, okay? And if we are starting at 7 o'clock here, and we have the new week opening gap for this particular week of trading, which forms on August 11th, Sunday's opening price relative to Friday's closing price. If we're above that, that's one checkbox that is likely to displace and move and deliver sell-side delivery. That means it's going to enter a sell program. It means it's going to drop. The price is going to have a sustained price run lower. It's further likely to occur if you have new day opening gaps clustering below where price starts at 7 o'clock. Well, you have your Friday new day opening gap and all the ones below it. And then you have last week's previous new week opening gap down here. See that? So it's likely to draw down into these levels. Wonderful. So now you have the first elements to building your understanding of bias. So you're not looking to go long. Even if the market springs higher and takes off and has a real huge dynamic price run, I'm not thinking, I'm probably wrong. I'm waiting for that to fizzle and run out, which is going to occur above old highs that formed after 7 o'clock. So I'm waiting for relative equal highs to form, and then I'm waiting for price to pierce above it. When that happens, I'm not afraid. I'm literally high on goofballs. I'm looking for the opportunity to see the price go below it, and it does right there. That validates that as a bearish order block. Not because it traded above London's high. That's not it. It's not, it ran stops above London's high. So now someone's going to call it the fucking, what they call it, the FU candle. It's an institutional candle. You fucking clowns. There's no such thing as an institutional candle. Okay, you fucking multi-level marketing motherfuckers. You liars, man. You're fucking liars. Come out here and call every fucking candle like I do. Do that. Then you'll prove that you have something. Hindsight, motherfuckers. Relative equal highs. Okay? It goes above that and then shows me, it proves to me that this change in the state of delivery, that opening price on that candle, I want to be at that price or between the low of that candle's wick on that candle. Anywhere near, that's my sweet spot. That's where I'm trying to trade. But my risk has to be defined as much as the midpoint or mean threshold of that order block. It does not need to be up here. Man, this is some good shit, ICT. Damn, this is good. Yes. I'm cooking out all week. Come back. I got some good shit coming. But that opening price, that's my entry on that candle. I don't have them up here, do I? Sorry. I'm sitting here acting like you can see the prices again. Here's the opening price, and that's the fill. Okay? That's the logic being used. And then in here, that's just human error, pushing the button. And I was looking at Piper thinking, man, you're messing up a perfect illustration today. But I love her anyway. And then the market trades with this fair value gap, and we have this order block as well. So the opening price on an up close candle, when the market is in a sell program, that means there's going to be sell side delivery. That means the market's going to be in a protracted delivery lower. It's moving lower. It's going down for a specific reason, for inefficiencies that are in a discount and or sell stops, which is sell side liquidity. So what does that mean? I want to be selling short when the market returns into any inefficiency or up at the butt end of an up close candle, because that's a bearish order block. Okay, so we have this candlestick right there. You see that? Look at that fill. What's it doing? I'm going to use the lowest threshold entry, the easy one, the one I know I'm going to get. I'm not going to worry about not getting it because of a limit order not filling. What is it? It's the low of that fair value gap on that SIBI right there. Right here, this candlestick right there. Defined by this candlestick's high. I want to use that candlestick's high. I'm using that as my point of reference to get into the trade, knowing full well that this candlestick right here is a bearish order block. But I have to afford myself the likelihood of it touching this fair value gap again. Notice that? So am I going to adjust the stop loss because this fair value gap formed and I went in here and added more? Am I going to roll the stop loss aggressively because it's afforded me another entry? No. And when I add to it here, am I going to trade and aggressively lower my stop loss simply because I went into a trade? No. I have to then wait for the market to roll out of this after it's proven it's doing what I want it to do. The bodies are being kept at the high of that fair value gap right there. And essentially the midpoint of this order block, which is mean threshold. So first time hearing this, if you're a first time viewer, right away, this is bullshit to you and you're going and looking for overbought, oversold indicators and moving averages. That's what you're looking for. You're looking for a signal service. And I want you to leave because I have no interest in dealing with people that are like that. I want to broom you quickly, okay? When I teach, I'm going to filter out the chaff. Because if you really want to learn how to do this, you're taking notes, you're listening, and you're listening for logic that repeats. And you're going to fucking hear me say this ad nauseum. It's going to repeat a lot. You repeat yourself so much. Go fuck yourself, comment boy, because I'm teaching. I want to prove that what I'm doing is a repeating logic. It's a repeating logic that you have to have ingrained in your understanding and when you're watching price. Because if it's not part of your intellect, if it's not part of your vernacular, if it's not part of your daily technical vocabulary, and you're going to fucking fail, aren't you? But guess what? If I'm constantly bloviating on about how this is what it is, and this is what it isn't, this is what it is, and this is what it isn't, and it's never changing, it's never morphing into something new, then it's scientifically proven. 9 out of 10 doctors will fucking approve that ICT's got his shit together, and it's going to repeat. So therefore, you have no excuse not to be doing this stuff and observing it and logging it and looking for these signatures to be in price action. That's the experience that you're lacking. That's what overcomes the fear and the anxiety and the worrisome thoughts that you're thinking. You're thinking the algorithm is going to stop working because here I am, I'm teaching it live in front of everybody, and now more people are going to learn it, and they're going to change the algorithm. No, they're not. They're not, okay? They're not, because this is the science of how price is booked. So if this is what price is going to do, are they going to be able to change time? 7 o'clock ain't never going to come? No. It's always going to be there. London session is always going to be there. The New York sessions AM is going to be there. The PM session in New York is going to be there. And you saw last week how to deal with the Asian session if you want to trade that time of day. You may do it wrong, but they're not changing shit. Okay? So anyway, as I was watching price action, I mentioned how, because these are relatively equal, what is it? Those are relative equal highs at 9 o'clock. If I had not taken a trade, say I was not in a trade, say I didn't have one, and I wasn't stopped out prematurely in gain, in profit. This is your 9 o'clock setup right here. Isn't that your relative equal highs? Isn't this price run from here up to there opposing where you think price may draw to? Where I was taking your attention here and I told you the new week opening gap last week. That's where it's going to draw to. Any clustering of new day opening gaps, that's your Friday new day opening gap. These are, the word escapes me. These are qualifying factors that put probability so far in your favor, and it was taught to you in advance last week, and the same logic is working here. Again, we're not trying to predict the closing price here, folks. We're just trading a session run. Something that's going to yield you something that is clear. It's one-sided. It's going to be very pronounced in price. It's not going to be something that, oh, it looks like it could have ran, but it's hard to tell there. No, it's definitely a run. It's definitely a protraction in price. It's one directional, and it goes to a level that can be predetermined. It's not random, okay? This type of lesson, I would have given anything if someone knew this and was willing to teach it to me when I was first starting. Because I would be all over these charts, studying, annotating, and putting all these things in a journal every single day and adhering to these rules. And I would be so much better the trader and person, and I wouldn't have all the mental baggage I have that I put myself. It was self-inflicted. But you have all the advantages of having this information now and going forward studying it and learning how to better yourself and avoid all of the bullshit nonsense that's out here There's so many things being told to you that this is what the market's going to do. This is what makes the market go up. This is a technique. This is a pattern. This is some horse shit. This is some algo. This is some kind of a indicator.